Welcome to the Game of Finance. I'm Matt Spears from Evoke Capital, and today we have the pleasure of John Howell's company. John, welcome.
Thank you very much, Matt. Nice to be here.
Very good. So John's from McBurney Chartered Accountants. John and I have known each other a long time. We work with many great clients together. Yep. And today we wanted to, touch on some content which is really going to resonate with the type of clients we speak to on a regular basis, being property owners and business owners as well.
That's right.
John, to kick things off, mate, I'd love to hear a little bit about yourself and your background and McBurney's Chartered Accountants and how you got to where you are today.
Thanks, Matt. Yeah, look, as Matt said, I'm a chartered accountant. I've been in public practice now for over 37 years. I started off in Canberra. That's where I went to uni. And I started working for a small boutique firm. Got my first exposure to tax and property investment as well. Quite a lot of public servants back in those days used to buy rental properties.
Yeah.
And the interesting thing about Canberra is all that land is leasehold.
Yes.
So always in the first year, they were always getting a big tax deduction for the stamp duty that they were paying and the legal fees they were paying. So I got my first inkling at how important property was to tax minimisation and long-term capital growth. So that was a really good start. Went and did a bit of time in the UK for 3.5 years, working for a publishing company, backpacking, living in a horrible house.
All the good stuff.
15 Antipodean people. And then I came back to Sydney and I've been at McBurney's for, the last 30 years.
Amazing.
And went to partner in 2004. And as you say, we help a lot of small and medium businesses with their structuring, their borrowing, their succession plans as well. We have quite a few generational clients that are passing the baton from the older generation down to the younger ones. We're seeing a lot of superannuation advice that we now have to be giving the boomers who are finishing up, and also the Gen Xers as well. They're starting to enter into that higher wealth creation phase. A lot of restructuring advice and using debt and property to achieve those things. And we're doing quite a lot of estate planning as well, just helping out clients understand where they're at, where they're going, and what their plan is for their legacy.
Super important.
And another part of our business really, which is a bit unrelated to property, is we do a lot of inbound international work. So companies coming into Australia to set up their businesses, and we just help them with, the compliance side and the back office work and making sure that's all taken care of. So
fantastic.
We've got a great mix of business, but it's the small business people, which you and I work on, that excite me the most, because they're the real people.
Absolutely. And it's amazing seeing their growth, right, from potentially being a husband and wife operator to building, this behemoth of a business, and
I know,
needing the right advice at the right time and the right support, which for me is what I get, a lot of my satisfaction out of is, just helping those individuals transform their business and be lucky enough to see it come to fruition as well, which is really cool.
Go to the next level. Yeah, I mean, one particular client we work on, which we both know about, but he started off as a one-man band in a van.
That's right.
And he's now built his business up to a
national business.
Yeah. And that's not without the help of professionals like yourself and me, just helping him achieve that goal, that dream. So, And look, we've used tax along the way. We've used debt along the way, and it's just enabled him to leverage and just go to that next level. So
absolutely. And I think, that's probably where a lot of business owners and even investors, they often ask, when it comes to how do I structure this? How do I buy this property? How do I buy this business? What's better, company, trust, individual name? And, what I've found is there's not a one-stop shop, or there's not one answer when it comes to what structure is going to be best for the individual. Like, it is so nuanced based on where that client is and where they'd like to go. But it might be great just to hear from yourself, if we're looking at structures, probably from a property acquisition standpoint. If we look at the benefits of, say, an individual, if we're buying a property in an individual name, whether it's joint tenants or tenants in common, versus, buying it in a company, versus buying it in a trust, I guess, what are the differences and the tax nuances you see throughout those structures?
Sure. Well, look, obviously with an individual, the tax benefits can be immediate, because usually they'll have a job or they'll have another income source which they can offset those property losses, that negatively geared investment against. And the tax benefit there is immediate. You have to make sure you get the right individual. So there's not much point having a working partner and a non-working partner owning 50% of a negatively geared rental property if only one person is going to fully utilise, the tax losses that get generated on that.
Oh, and that's a great point. And I think it's a point that probably isn't considered enough is, while you're husband and wife and, 50-50 or whatever your agreement says, if you've gone in 2025, how it works these days, you need to consider whether 50-50 ownership structure is the right one.
Yeah.
Because it could be tenants in common where it's 99-1 or 100% with one individual and husband or wife at 0% because you want to offset the income of that high income earner.
Yep.
And that's driven by the ownership of the asset, not so much the joint borrowing of the loan facility.
Yeah, it really does reduce your after-tax holding cost if you're going to be utilising a taxpayer at the full marginal rate. So someone making over $190,000 a year, for example. So that's a big thing. Also, understanding what the plans are for the family over the next year, 5 years, 10 years. Is someone going to take a break? Is someone going to be going overseas? Because obviously your status as a tax resident is very important now with property ownership, where there was a whole lot of people who own property in Sydney here who decided to go and work overseas and cease their tax residency. And that has very serious capital gains tax implications.
FIRB?
Yeah, no, that's really being denied things like access to the 50% discount.
Oh, I see. Okay,
So
wow.
Not necessarily land tax hits, because these are Australian citizens that are going overseas, but where they try to sell their property and they're a non-tax resident of Australia, the calculations to work out their capital gains are very severe.
Wow. So CGT free is the best, I guess, exemption we have in this country. I talk to people all the time who may be living in a property and want to move into another one and they're not going to sell their existing one. I always say, have a chat with your accountant because CGT free for your owner occupier is the best, I think, tax incentive that we have.
It's the best tax haven we have,
absolutely.
That and superannuation. So absolutely no arguments there. But as I say, the residency is a big consideration and that will determine, whether or not you sell a property when you're a non-resident or whether you do it before you leave or when you come back. So
amazing.
We have quite a few clients who are in that boat. They go and work overseas a lot and it's very important they get their timing right when they're doing that. So that's individuals. With companies, generally we don't see much in the way of property ownership. We'll see property development in companies, but not so much ownership because companies don't get any discount at all for the capital gains. And when you have capital profits on eventual sales of properties in companies, they'll have to come out sooner or later and they'll come out without any tax credits. So sometimes the individual, when they get the future distribution, will have to pay some top-up tax.
Top-up tax.
You could end up paying 47% tax.
Yeah, the top marginal rate.
So
what about any land tax benefits in companies versus trusts?
Well, trusts, again, you have to be very careful. You don't have any foreign beneficiaries. The Office of State Revenue here in New South Wales, as every state has, they are very interested to see who's on your register of beneficiaries because we're in the situation where you do have a foreign beneficiary, you could get taxed or the trust could get taxed as a foreign landowner.
Right.
There's a real risk for that. So they're actively looking around. And so you must make sure if you are going to use a trust that you only have Australian beneficiaries, resident beneficiaries there. Losses can get trapped in companies and trusts as well. They can only be offset against the income being generated by other divisions or businesses within that.
And that's a good point. It's businesses, right? If you're PAYG and earning your income after tax, being paid by, say, your employer, very hard to offset and get that into a company, or impossible to get that into a company or a trust to offset those losses. So you may be foregoing offsetting those losses for a period of time, unless you look to start up a business in the future or that property becomes cash flow positive, and allows you to offset those losses held.
That's right. And as individuals, you can access the land tax-free threshold by state. So we've got some clients who own properties in New South Wales, they own properties in Victoria and Queensland, and they've got the benefit of, as individuals, of accessing those tax-free thresholds per state. Unlike payroll tax, which looks at Australia-wide wages, they're not looking at Australia-wide property. They're just looking at each property in each state. in isolation. So
And that's as
advantages.
That's as an individual.
Yeah, that's right. Trusts, you can access the tax-free threshold, but you have to get your deed prepared properly, and it's a little bit more complicated. You've got a bit more in setup costs. You've got a lot more in compliance costs, whereas as an individual who's just putting a rental property schedule in their tax return, that's just an extra couple of $100 a year for their tax agent.
Yep.
If you're running a trust or a company with property, you're talking several $1,000s.
Yeah, it's very different. It's material, especially for somebody who hasn't been exposed to, I guess, the costs of running a company.
Yes.
The amount of work that goes into creating those financial statements, tax returns. It's not a cheap cost. So you do so with, and you want to do it with eyes wide open, understanding what is going to, I guess, end up costing you down the line. Yeah,
look, people get it in their head that having a company or a trust is a great asset protection mechanism, which is true. It is. It's a separate legal entity, but don't go too far with that concept because, again, there are other implications as well, and you really need to speak to someone who understands these things. And it's important that when you're talking about it and you're moving to that purchase stage, the broker understands, the mortgage guy understands that this is how it's going to be structured, because not all the deals are simple.
Correct.
You could be using security that's owned by another entity.
Mm-hmm.
I've seen documents and paperwork and loans set up incorrectly because they weren't done in the individual's name, they were done in another entity's name. So you need a really close it's a cooperative process, getting that debt structure right and getting the right entity purchasing the property.
And I think that's a team approach, right? I think what we've done really well with the clients that we co-manage is, we take a collaborative approach to structuring debt. So,
yes.
We have a look at, okay, what are the pros and cons of structuring it in this way, in this vehicle? What are going to be the tax, I guess, outcomes of doing so? But what are going to be the lending benefits of doing so as well? Because I think sometimes, and I had this conversation this morning with a client, it's about, yes, there's tax considerations, and potentially buying a property in your personal name is going to be the best tax outcome in terms of being able to offset the income tax, that you're paying.
Yes.
But is it going to be the best wealth creation vehicle? Because, if from a lending perspective, if you can buy one more property in your personal name, and then you've hit that serviceability wall for the majority of banks. But if we were able to structure it differently, and we could potentially increase your foundational portfolio and buy you another $2 or $3 million worth of property, while that tax benefit in isolation is great, if we could increase the size of your portfolio by $2 million and be earning, $150,000 worth of equity per annum versus, $10,000 to $15,000 tax benefit. Yeah. That's where we start to have more of a holistic conversation around, is it wealth generation or is it tax optimization? And we probably need to pick one depending on what we want to do.
Also, having a broker who understands that what they're seeing in the owner's tax returns isn't the real income situation or the cash flow situation.
So it's accrual based.
They might be supplementing their lifestyles with dividends. So their borrowing capacity might actually be more than it first appears. If you just look at the individual in isolation, that might not give you a full, complete picture of what the capacities are. So I think that's where we've worked well together, Matt, is understanding where all the income is. And sometimes you'll park a lot of that and cap the tax at, say, 30% in a company situation for that business profit, but that individual might have capacity to borrow more than what's actually in their return. It's your job trying to convince the bank that they're a good bet.
They're good for it, that's right.
It's how you communicate that as well, which is very important. And, people have expectations. Well, my company turns over $10 million a year. I've got $2 million in profit. What do you mean my taxable income of $100,000 isn't going to let me borrow a $2 million commercial property?
That's right.
We probably need to think about setting that up in another trust or something like that.
So in terms of, I guess, distributing the money out of the company, or leaving it in the company, there's still a lot of options available for individuals. You don't have to distribute all that money to yourself.
You don't.
It is interesting, but there's a number of other structures as well that people could look at to borrow with too.
Well, yeah, the other one which is becoming more and more, talked about, and it's a hot topic of debate at the moment, is superannuation funds, because a few years ago the government changed the rules so that superannuation funds were allowed to borrow money and they're allowed to purchase property. and in some cases commercial property off a related party. And that was really to cover those situations where you had a business operating over here. They had a business premises, but they didn't quite have enough money to fund the acquisition of that business premises. So what better place to go than a superannuation fund and have that arm's length lease between the super fund and the business. And so that opened up a lot of doors. And so people walk through those doors, and now we see examples of people purchasing holiday homes, which they're putting on places like Airbnb, or they're renting them out for short or long-term accommodation. So as we go down, we see more and more property being acquired in superannuation funds. Now it's a challenge for the lenders, because the conditions on those loans are that they're limited recourse borrowing arrangements.
Correct.
So
they're governed by the SIS Act as well, right?
Yeah,
so which
correct.
is very, I guess, particular in its wording of uses.
Very prescribed, 15 years, set rate. So the lender doesn't really have any way to move. They can't be too creative because they've got to comply with those regulations and things. So unless you're really maxed out on your super and you've got plenty of cash, it's getting more and more difficult now to start from scratch with an LRBA. Again, the banks have struggled with them as well.
Well, the banks have exited, actually lending via self-managed super fund. For the major banks anyway, there was too much risk, and that sort of came from, I guess, the reviews around financial planning in their wealth management divisions, which they've all divested from or totally separated. But there are a number of non-banks, that have jumped into this space because I guess what we've seen from clients is that they are looking at it as a way to diversify from having purely equities based in their super fund and adding an element of property to it, and often having an asset come into their world that they're not actually paying for out of their take-home dollars. They can use their superannuation guarantee to pay for, but they need to get the right advice before they jump into it, right?
Yeah, look, there are some great little prizes at the end as well. So when you do retire and go into that pension phase of your life, and you can start liquidating assets without, in a lot of cases, without paying any capital gains tax.
Yeah,
exactly.
Yeah.
So there is your nest egg. What some people struggle with a little bit is letting go at the end because they've got an emotional attachment to that property. The thing is, that property might not be yielding enough to cover the pension that you're required to pay. And it's not like you can take part of the house as a pension.
That's right.
So sometimes, people are left with a situation where they have no choice but to liquidate the investment. But, when you think about it, that was what you originally set out to do in the first place. So you have to go back and remind them, hey, listen, this was always going to be something just to see you through those working years ease off your other cash flow.
Yeah, you've been able to use leverage to buy an asset, turn $2 into 10 and get, a similar return on that principal. It's cost you some money along the way.
It has.
But that's where we've actually seen clients, who I guess have bought their business premises, sell down their business, retain the premises, sign themselves up to a nice lease with, nice increments over time. To be able to add that element of cash flow to their retirement, or potentially, sell down their residential property in time and move it into a commercial asset that's going to get an enhanced yield. That's
exactly.
What their
the yield's very important, So that's going to give them a more realistic chance of making that minimum pension requirement that they need. So, I've seen super funds with, a lot of commercial property in there, and they do really work well. The ones that struggle a bit are the residential ones,
What about the $3 million cap? Because that's obviously new. It's raised some eyebrows.
Oh, God,
it's not indexed from what I understand.
Correct.
Today or yet. What are your thoughts on that? How is that going to work with those that want property as part of their asset allocation? Because that's going to cause havoc for those that are really investing in their future, which are doing what the government set out to do with super in the first place.
It's created no amount of angst and anxiety amongst our clients who do own property in their super funds, because they're going to have to get a valuer every year, come in and put a price on that property, and before they know it, they're going to be over that threshold, and they're going to start becoming liable for this additional tax,
the unrealised
which is going to be another burden on the super fund. So again, finding the money to cover that could be a challenge if you've got all your stuff tied up in, all your assets tied up in property and things you can't liquidate quickly. Matt, it still hasn't been set in law. They're still arguing over the threshold. I think the Greenies want that threshold set at 2. We're going for 5. I don't know. I think we're going to end up at 3. But it has created a lot of anxiety. we've run the numbers through quite a few scenarios, quite a few clients. It still is a better way to hold appreciating property
really
down the track, even if you do have to pay this additional Div 296 tax. This is what we found anyway,
sure,
in quite a few of our analyses. But yeah, it is creating a lot of stress at the higher end. Yeah, we've had to hose down some expectations, but again, we still don't have the law as what we understand. I just know that valuers are going to be extremely busy. They're going to be
somebody's going to benefit from it.
Yeah, that's
and it's
right.
not just going to be the Department of State Revenue.
It's a typical sort of government. It's a sort of typical thing that.
Also, it's a federal tax. That's right.
Yeah, and look, to be honest, that's about the only reform they've done of any substance. So. We were going through training sessions every week where we were talking about that new change, and I was thinking, well, is there anything else we can talk about? So, sorry, that's all they've got. It's a cheap shot, I think.
Yeah. I agree. It's really disincentivizing a system that they built to incentivize people to invest in their future.
Moving the goalposts.
Absolutely.
It's really unfair. And the other thing is these people are going to be helping the generations behind them as well in helping fund their future dreams and goals. So, it's a bit of a shame, but again, we don't have a lot of certainty still. They're still arguing over it. But it has had an impact at the higher end for sure. So let's see how it plays out. Again, I think some people have overstated a little bit the impact. It's not as bad in some cases as it sounds, because you do get a reset. We're going to get a reset now at market value. But I think philosophically it's a really hard one to swallow because we're the only tax jurisdiction in the world where we're taxing unrealised gains. And that's a really big shift in tax world and accounting world is taxing the unrealised. Because what happens when the value goes down? Clients are saying, well, this doesn't seem fair.
You're not going to get a credit, are you?
They're dead right. I don't have an answer for them. It's just basically tough luck.
Watch this space.
Yeah. Hopefully we'll get some reprieve.
Fingers crossed.
Yeah.
Unless you need to step back into Canberra, mate, and sort it out. Who knows? Life after accounting. Could be the next foray.
Zero influence there. Thank goodness. Yeah.
Just something that sort of occurred to me off the back of that last point. Div 7A.
Yes.
Big challenge for a lot of business owners.
Oh, yeah.
How do you get your money out, move the money around, to be able to get the best of both worlds in terms of using it. I guess, some people put it in their offset account in their home loan, which can sometimes crystallize into, your director's loans. Could you tell us for the audience what a Div 7A loan is?
Sure.
And I guess how that works for a business owner who's looking to try and get profits out of the business but not pay tax on it straight away.
That's right. So obviously, if you've got a business in a company that's paying tax and you're paying tax at a rate of 25% if you're qualified for that small business rate, or 30% if you're larger, the money sits in the company. Now, sometimes that money's not doing anything. So the owners or a related party might choose to borrow that money off the company and do something else with it. They might go and buy a rental property, or they could, as you say, put it in their offset account, which is probably more common scenarios we see. The ATO are looking at this. They don't like that idea because they think, they do have anti-avoidance rules where you do a back-to-back arrangement. So they're targeting people who are doing these loans. They're repaying them on the 30th of June and then redrawing them again on the 1st of July.
That's right, kicking it out.
That's exactly what they're looking for.
Yeah.
Division 7A is a very expensive way to borrow off your own company as well, because the rate that you have to charge is 8.47%. Okay. Now, I'm sure Matt Spears can probably do a little bit better than that. That's the rate if it's unsecured or secured.
Gotcha, because if it's a secured rate, they want you to actually take a caveat or a mortgage over
that's right.
a residential asset.
So you can draw it out over 25 years. Now, if you've used that money for a private purpose, that's a very expensive way to go, as far as funding goes. You could go to the bank, Matt, and you tell me what, if you've got
you get money in the fives.
Yeah, and we just had another little cut the other day. Now, Division 7A is deliberately set 3 or 4 points higher because they a percentage points higher because it's a disincentive to do it, right? They don't like it. They'd rather the company pay a dividend to the individuals and then they pay the top-up tax. They get a credit for the tax the company's paid, but they pay the top-up tax. But sometimes, people don't necessarily need that. There might be other reasons why they don't need all that extra income. But they'd like to have the flexibility to use the money. So this is where a broker can come in as an alternative to borrowing off yourself because it is actually cheaper, especially if it's for a private purpose. So I'd warn people doing these back-to-back arrangements. The ATO are onto it, and we've had a few clients who, had reviews. They weren't audits; they were reviews, and the ATO were very interested in what the Division 7A loans look like, what the unpaid present entitlements look like. They really had to drill down, and they really wanted to drill down and look at those. So
because they are on that alert post-COVID, right? They're trying to pay back those, incentives that they provided small business.
They know the tricks we play and the people play out there. So just be wise to the fact that that's definitely a thing. But as I say, it's always cheaper to go to a broker to borrow the money if it's for a private purpose. Sometimes there can be a benefit if you're borrowing money off your company for a investment purpose, because obviously you're getting a tax deduction at the higher rate, but then you're also and then the interest income that's being made on that loan by the company is getting taxed at a lower rate, but you still have to make a minimum repayment.
Gotcha.
And where's that going to come from?
Yeah, is that 15 years or is that 25?
Exactly, mate.
Yeah.
So you've got to think, well, how am I going to fund this? Guess what? Dividend.
Correct.
Oh, God, now I'm back to square one again.
That's right. So and that's where, if you've got the luxury of equity in your home, it could be a great funding means.
Yeah.
We've had clients where we've looked to fund out directors' loans, by way of loans against the business, and the intrinsic value of the business, not just bricks and mortar that the business owns, actually leveraging the balance sheet that business has, or potentially the cash flow generation and the profitability that business has showed over a period of time, where the bank said, we're happy to do what we call a cash flow lend because we're so comfortable in the results of your business. So we've done a number of those where we've been able to tax effectively provide the clients with, I guess, that cash to be used for, investment in residential property, commercial property, businesses. And again, we got to that point, working collaboratively with their team to make sure that, those facilities we're putting together are going to suit, the clients, the bank, and, ultimately the tax structure as well. Yeah,
it's got to be tidy and explainable. And, the bank needs to see it in a way that makes sense for them as well, because they'll have a legal team poring all over it, looking for any holes.
Absolutely.
So we've all got to be on our, on our marks there for that. So, yeah, I'm just glad that the broking industry has gone a long way to recognising that not everything's vanilla. That's right. There's a lot of flavours out there.
It's a lot of flavours out there, mate, and the flavours keep us on our toes, but it keeps us in a job as well.
That's it.
But it's generally where the exciting stuff happens. Those clients that have those bigger businesses, they're always going to have curly things happen, and they're going to rely on their advisors to help push them through. And I think, probably a good segue off the back of what we just spoke about, residential property or commercial property. I think something that I'm quite passionate about talking about at the moment is business owners that put their heart and their soul and all their energy into building their businesses, but don't invest along the way. And from what I see is there's so many people that have built these amazing businesses, but could be totally derailed by a down year or being disrupted.
That's right.
With their industry changing. And if they're not reinvesting that income into assets outside of the business, they're potentially doing themselves a disservice in their wealth creation journey. What do you think about that?
Yeah, I agree. That is a risk. And I think you've got to diversify your income streams as well and think long term. So the best way to go long term is obviously property or shares. But, when you're so busy running a profitable business, that's great. But you need to have something going on the side that's passive,
right? That's right.
And commercial property is good because you can keep your eye on it.
Absolutely.
You're running your business out of there. If something happens to the business, well, okay, but the property trust that owns the commercial property is still bubbling along. You might think, well, hang on a minute, I think we're too big for these premises now, or we're too small. Let's get out of here. Find another tenant.
Absolutely.
Okay? Keep the wheels turning. So, again, commercial or resi, commercial, you're talking high yield. look, if you buy in the right place, you obviously got the good capital growth. But
Absolutely.
traditionally, there's been so much capital growth on the residential side with low yield. It makes more sense for a high income earner to be perhaps thinking about resi, negatively geared residential, because they do have that big capital gain down the track. Hopefully, they can take advantage of those land tax concessions we talked about earlier, but they can get an immediate tax benefit. But commercial really does have its place now. I mean, I've got clients who can't find warehouses, can't find storage space. And, it's been another challenge with our other guy that we deal with, you and I together.
Yeah, absolutely.
Finding places to put things on a commercial basis. It's a challenge. So owning it is much better than leasing it. You don't know what your landlord's going to do.
Well, that's right. And while you may have a long lease, if there's a demolition clause, you could be out in 12 months, right?
Yeah.
So
you could be getting knocked down for more units.
Exactly.
I mean, I've seen
look
that
at Rose
happen.
Bay, what's happening down there, it's, people doing the syndicates and, amazing, crazy money being thrown around,
a few
right?
clients, have been caught up in all that. Those little neighbourhood syndicates you're talking
Pockets,
about,
yeah,
it's
absolutely.
unbelievable.
It happened in the hills, in Sydney, where people did those massive syndicates. And I think, I guess in terms of resi versus commercial, it's very much dependent on the individual. Some business owners have, I guess, a preference of commercial because they're earning super healthy cash flows.
Yeah.
They may have already, a great home that's got a lot of wealth tied up in that.
Mm-hmm.
And for them, it's really about diversifying income away from the business. And commercial property is their vehicle for doing that. Keeping the money in, bucket companies and the corporate tax environment, chunky deposits, so those assets are cash flow positive from day one.
Yep.
But others that are still on their growth journey, we see them leaning more into residential because we're getting higher LVRs. We can put less money down to get more loans to be able to buy better quality assets.
Yep.
But we have a view to build that foundational portfolio and get into commercial, at the end of our journey, either when the business scales up to a level that we're getting that level of profit, or if we choose to liquidate, the resi portfolio and redistribute that profit into commercial. But shares also in there as well. A lot of guys looking at leveraging, equity out of their property to say, I want to diversify away from just having property and have an element of liquidity, that's working for me as well.
That's right. Yeah. All those things make sense. And banking and lending and borrowing have become a lot more sophisticated over the last 5 to 10 years than what it used to be like. Unless it was a two-dimensional prospect, it was hard to convince someone to lend you the money. But now I feel like people are a lot more educated and a lot more sophisticated in their approach. So I agree with all of that. It's good.
Very good. I was going to probably touch on just a case study and get your thoughts on, I guess, what business owners can do, which some of them may not know they can do. And again, this is probably for our bigger business owners that have got an established business that's turning over multiples of millions and that they've got a strong balance sheet or that strong cash flow. But, we I guess, had an example a couple of times in our business over the last 6 months, but one that we worked on together where we were able to move some debt off property and actually free those assets up to be able to sell those assets and actually be able to bank, those multiple of millions, in our pocket, not the bank's pocket, and pay down that debt. Which again just opens up a lot of options for, whether it's investment in super, whether it's investment in shares, whether it's investment in resi or commercial property. Do you think many businesses know about those type of arrangements?
Well, no, because those things come out when you start talking with the accountant, with the broker. And I think the example you're talking about there was a lifestyle. There was a bit of a lifestyle situation going on. One of the owners was suffering from a bit of a long-term health issue as well. So they wanted to move closer to the beach, which is great. And the way we were able to get that debt off that other property that they owned gave them a little bit more flexibility and some more options there as well. So it's understanding this, where the family's at and where those individuals are at. And if there's opportunities there to restructure the debt, I don't think we restructured anything there. We just moved a few things around.
The debt stayed the same. It was just the security that sat behind it, which freed it up. Because what I see is that banks love having their hooks in everything.
I know,
right? A credit manager, they're going to feel safe if they have a GSA on this entity, that entity. It's all cross secured. They've got mortgages over your house, the commercial property. They will take everything if it's on offer. And it's the first thing we go in and say, well, you don't need that, you don't need that, you don't need that. And if you don't do that, we'll just go somewhere else.
Yeah.
We want to work with you,
Yep.
but you can't be greedy. You need to give clients the flexibility to be able to sell assets independently and not tie everything up.
Yeah. So the prospect our client faced there, Matt, you recall, is that if they were going to sell their original home, which they did have that big mortgage on which we took off, the first thing they were going to do is offset, repay the mortgage. And part of that mortgage was for business and part of that was for personal. And that did not suit anybody.
No.
I was scratching my head thinking, how are we going to do this? We've got to do it a better way. And I think, working with you and the team, you guys were able to remove that security and free up and keep the business debt. That was important. That's important for our client.
And providing that working capital as well.
I know,
it sort
right?
of opened us up to be able to take the business through that phase of growth that they're experiencing, which was a huge need, that we had at the time, right? So I think it all landed really well, and that was a multi-bank strategy with 3 banks. It wasn't an easy one, but it was one that I'm really proud of because I feel like the foundation we've laid is going to be really, really important moving forward.
That's right. I mean, it's a dance for sure, and the way you managed that was really good. And the client got a great outcome. I've spoken to him a few times since, and that's given him a lot more, bigger sense of calm. He's able to focus now back on the business and how he's going to grow that. And he's also rebuilding his business. He's got a good team around him now as well, which is great to see. And everybody's moving in the right direction, and the same direction. So, absolutely. I mean, you should really be revisiting your debt and how it all looks and how it relates to your business and what's going on in your personal life and your investment life. I mean, you tell me, Matt. I mean, I would have thought at least every 2 or 3 years.
I think at least once a year.
Once a year, okay.
Depending on how much your business is changing and growing or contracting, or what you're looking to do. I think it should be a part of the conversation when you're having your strategy sessions, because no doubt I think what some clients tell me is they want to make changes to how their income is perceived to the bank, but because they're doing their strategy sessions after the financial year end, they've got limited options to do that. So in terms of, when you're chatting with your clients, when do you think individuals should chat with their accountant when they're looking to put together their year end position?
Well, you should be speaking at least twice a year, I think. I mean, for a non-business client, you should be just reaching out, having a chat about things like superannuation, debt.
Yep.
What are you thinking? What's your plans? Where do you see the family going? Absolutely, twice a year, at least. But for a business client, you should be meeting with them every quarter.
Yeah.
And one of the agenda items should be debt
100%.
or structure.
Yeah.
Right? Cash. I mean, you talk about cash flow, you talk about profit, you talk about, what are we buying here? What are we doing here? What's the plan? But absolutely, debt should be right up there on the agenda, and keep asking questions. Keep asking, could we do it better? And bring in the experts as well and say, listen, here it is, guys. What do you think? Could we be paying a lower rate of interest? Because obviously that's what people are interested in doing. Can we string out the payments a bit longer?
Yeah, smooth the cash flow out.
Keep the bastards honest, mate. That's it.
No, but it's true. Unfortunately, the loyalty tax. The loyalty tax doesn't do you any favors. Staying with the same bank, they do get complacent. Relationship managers do change. Often every sort of 24 months. If you have somebody great, they're probably going to get promoted in time. And I guess our value prop to our clients are we're your bank agnostic relationship manager. So regardless of who moves and changes, we're your constant. We can make sure that we reiterate your position to the bank in a way that's going to be conducive to good credit outcomes. But I think you're right. Every quarter, every 6 months, talk to your accountant before the end of financial year if you want to make a change. And it's not even about wanting to make a change. It's about so you can be strategic. I think that's probably one of the best takeaways of business owners from today's chat. But maybe for property investors, what do you think a takeaway for them would be for today?
Keep asking, keep talking, think about what's possible. Just see what you can do. Don't get complacent. Don't be satisfied. Always look to grow.
Absolutely.
Right? You should be looking to see what else is possible. It is easy to become complacent, but you should always try to be thinking about going that little bit further and just tapping the market and seeing what's out there.
And treat property like a business. If you're a property investor, you should treat it like a business and look at it through the same lens.
Don't be satisfied with what you've got. What else can you do? you know, and the loyalty tax argument's great, but yeah, reach out and see what's possible. Sit down and prepare a balance sheet, family balance sheet, and see, people's circumstances change. They come into an inheritance. There's a windfall. So whenever something like that happens, that screams opportunity.
Absolutely.
To me, right?
Absolutely.
Hello. Okay, sure. We're getting $100,000 here, but we could actually turn that into a $400,000 or a $500,000, outlay on something else.
Absolutely.
Which would be great for tax, great for long-term capital growth. Rather than having $100,000 sitting in the bank account. I mean, that's pretty boring.
Well, that's right. Yeah, it's boring, and it's one of those things. It's opportunity cost. Having your buffers are important, but could that buffer be in an index fund? Perhaps that's your hurt money, your buffer money, that rainy day in the event that something goes wrong. Because I think that's super important, whether you're a business owner or an investor. You want to make sure you've got some money there, for the down times. It's not always sunshine and rainbows as much as we would like it to be. So having that hurt money there is important. John, thank you so much for being here today, mate.
Hey.
I think this has been a ripper chat. I think we've got through a lot of great information for business owners and property investors. But where can people find you if they want to get in touch?
Yeah, sure. Look, we're on the website, mcburneys.com.au. We're on the corner of Pitt and Hunter. Please feel free to reach out anytime you like. We're always here. And again, we're the sort of firm that when you ring to speak to someone, you'll be able to speak to them. You're not going to be going through a chain of managers and, call centres. We are real people. So more than happy to chat. And Matt, thank you very much for having me today. It's been very interesting.
Pleasure, mate. Thanks for coming.
Awesome. Thanks.